Hello, and during this segment of the basic rules of operating a nonprofit organization, we're going to be discussing fundraising. This portion of the presentation begins at slide 44. First thing I want you to understand is that if you're going to fundraise or solicit for donations, you need to understand that state governments regulate this activity, better known as charitable solicitation. And there's charitable solicitation laws in a variety of states, and we're going to get into that in more detail. But the reason that states regulate this is because they want to protect their citizens from deceptive or abusive solicitation practices. They want to protect them from fraud. And they want to make sure that the people who are soliciting for donations are people that have not been convicted of fraud. I want to set some context for this part of the presentation as we discuss this for the next period of time. First, I want to point out that the IRS Form 990 requires disclosure of fundraising expenses. So as you conduct charitable solicitation activities and as there are expenses associated with those activities, you need to be tracking those expenses so that you can make sure that you include that in your Form 990. In addition, you should be cognizant of the fact that protecting donor information is critical to your organization. Your donors are obviously an important aspect of your existence, and you want to make sure that as you obtain donors, you want to protect the information that they're providing to you. In addition, credit card companies that you may be working with may require that you have certain privacy practices to protect your donors and their confidential information. So this is sort of an overview of a couple issues that I wanted to mention as we get started. Turning now to slide 46, we're going to jump in and talk a bit about charitable solicitation laws throughout the United States. 39 states in the District of Columbia require nonprofits to register with the state before fundraising in that state. Of course, it'd be great if all these states had the same charitable solicitation law, and there's just one law and you need to comply with that. But unfortunately, it doesn't work that way. Every law is different, and the requirements differ state by state as a result. But it is key to note that generally you must register if you are soliciting the general public for charitable contributions in a state that requires registration. It's important to note that that's the general public. Almost all 39 states require that. Well, let's turn to slide 47 and give you an overview of where an organization would need to register. And this is just some high-level questions to have in the back of your mind as we go through the rest of this presentation. Now, 20 years ago, this was a much simpler question. There was no internet, there were no websites, there wasn't email. There certainly wasn't Facebook or Twitter or any of the other social media aspects of charitable solicitation that exists today. And so the world we're in today is far more complex, but these questions still apply. So we're going to walk through them to give you some context as we move forward. So the first question is, has my organization purposefully directed a charitable solicitation to a resident of state X? The answer to that question is yes. Then the next question is, does that state require registration? If it does, then you need to look at several other questions. What kind of solicitation was it? Does the organization conduct other activities or have a presence in that state separate and apart from that charitable solicitation? And you need to start evaluating the circumstances surrounding your solicitation activities and other activities in that state. We're going to go into that in more detail a little bit later, but I want to put that in mind as you think through in the discussion that we're having today. A nonprofit must register in every state where it solicits contributions if that state requires registration, as I said. Just registering in the state in which you're located or incorporated is not sufficient. So if you're incorporated in Connecticut and your main operation is in Connecticut, but you're soliciting donations from people in New Jersey and New York and other states, you may need to register in those states. Just because you registered in Connecticut will not be sufficient. And it's particularly important, as the last bullet point on this slide points out, in areas like New York City, that metropolitan area, or the DC metropolitan area, where people are constantly moving about in multiple states, almost on a daily basis, often working and living in different states. And the interconnectivity of those activities and the likelihood of charitable solicitation in multiple states increases significantly in those sorts of metropolitan areas. Turning now to slide 48, let's talk for a minute about the registration process. Again, this process will vary state by state, so you have to look at your state that you're particularly looking at, where you need to register. But there are some generalities, and that's what we're going to cover now. So usually when you register in a state, you have to disclose a certain amount of information about executives, financial information about the organization, and there's a registration fee usually. Some states it's $0, but it can go up to as much as $2,400. And it depends in part upon the size of your organization and, of course, the state. So some states, if your organization's income level is significantly higher or in a higher range, then you have to pay more for your registration. Some registrations are annual, some are every other year. You have to look at the specifics of that state. And when I say annual or every other year, you file an initial registration, and then you have an annual reporting requirement. And then, and through that annual reporting requirement, you're often re-registering. But that varies again state by state. So another thing to understand is that, like I said before, you have to register prior to soliciting, or you can be subject to some fines. Some states are more stringent about applying those fines where people have solicited prior to registering. The last bullet point on this slide is pretty important, and that is that it's not just nonprofit organizations that must register, but also people who are considered paid solicitors, fundraising consultants, and sometimes commercial co-venturers. Briefly, a commercial co-venture is a for-profit business that sells goods or services of some kind, and they enter into an arrangement with a charitable organization to conduct a charitable promotion. And it's usually for a limited period of time, and that makes them a commercial co-venture. So in states handle commercial co-venture activities differently, and we're going to talk about that a little bit more later on. One important thing to note is that it's illegal to use an unregistered fundraising solicitor or consultant in some states. So you really need to understand what the state's law in which you're soliciting are, and what the requirements are, not only for the nonprofit to register, but also any fundraisers that you may be using, fundraising counselors or consultants that you may be using to fundraise in those states. Of course, there's an exception. There's always an exception to the rule. So every state has exceptions to registration requirements. The most common are religious organizations. They usually do not have to register to solicit for charitable contributions. Also organizations that raise very small amounts of money. As a whole, the organization may only have a few $1,000s, and if that's the case, they often are accepted from registering. But then some states have certain types of organizations that don't need to register, for instance, schools or fire departments or others. Again, you have to go and look at each state where you're soliciting to see whether you fall under an exception. Now let's turn back to the issue that I just highlighted briefly, involving activities that require your nonprofit to register. So what are those specific activities? I gave you some bold questions to be thinking about, but now we're going to drill down a little further. So let's talk about the term soliciting and what it means and what activities it encompasses. Generally, soliciting includes fundraising appeals made to the general public, including appeals made via mail, email, Facebook, Twitter, telephone, public service announcements, and other broadcast advertisements, online advertisements, or the traditional in-person door-to-door or at the airport or out in public solicitations. But it also includes solicitations to corporations and private foundations in some states. And solicitation can also include government grants in some states. Each state law has its own definition of solicitation, and you have to make sure you're looking at that. Another area are ticket sales or gala events or golf tournaments or things of that nature. Any kind of similar event where it's clear that the purpose is to raise funds for a charity, that would constitute charitable solicitation as well. There is one caveat that I want to mention, and that is that some states do exempt organizations from registering to solicit in their state if they only solicit government, corporations, and foundations in that state. In other words, they're not soliciting the general public. Again, remember, the purpose of this is to protect the citizens of that state from deceptive or abusive practices. So if you're not soliciting the general public, in some states, you need not register. Now let's go into a few more details about where to register and thinking through those questions we discussed again. So now we've got the definition of solicitation. So where are you soliciting? Well, if you're soliciting in a state and you're physically present in that state, in other words, you have offices or you regularly conduct business in that state, or you're soliciting via mail, telephone, or other kind of clear presence in that state where you're soliciting, and you solicit actual contributions, then you probably need to register in that state. So again, it's a physical presence kind of test. It's, do you have connections to that state beyond just electronic? And if you do, and you're soliciting donations, then you likely need to register in that state, assuming there's no exceptions and all the other rules that we've talked about, and that there's a solicitation law in that state. Now let's turn to slide 52, and we're going to spend some time talking about the internet, email, Facebook, Twitter, Instagram, and all these wonderful new electronic formats. In the year 2000, state officials, charity officials, got together in Charleston, South Carolina, and they created a series of guidelines or principles surrounding internet fundraising. Now, understand that in the year 2000, social media really didn't exist. There was not Facebook, there was not Twitter, or Instagram, or any of these other forms of social media. So the focus was really on website activities. So they created these guidelines and they took them back to their states. And a couple states included those guidelines in their state charitable solicitation laws, but many do not. And so they remain in many states simply guidelines and things to think about. So I'm going to discuss these guidelines, but again, you have to go back to each state's law and see what the law actually requires in that state in terms of registration requirements. So the Charleston principles in determining whether to register, the nonprofit asked the following questions. Does the nonprofit's website allow for online donations? Well, most websites, charity websites today, do allow for online donations. And it doesn't matter if you use a third-party vendor to collect and actually collect the credit card information, like a PayPal or something like that. But if through your website you have a section where a person can donate, that would be what we're talking about here. The answer is yes. And the organization receives contributions on a repeated and ongoing basis or a substantial basis through this website format from a particular state, then the organization may need to register in that state if that state requires registration. If the organization has offline solicitation activities where they're asking the donor to go onto their website and donate online, then that can also qualify as well. So do offline solicitations ask a donor to complete a donation online, or do you solicit by email? And that's important. A lot of people have at the bottom of their email a donate now button. That donate now button directs people to the organization's website and promotes website giving. So if you have that situation, then the organization, the nonprofit, must register in the state where they solicit donors using this method, or from which it regularly receives donations, according to the principles. If the nonprofit's website doesn't allow for online donations, and at the time in 2000, there were a lot of websites that didn't have that function, that you didn't actually donate online. Today, I think there's probably very few, but I will go over the principle as it was laid out in the year 2000. And that was that if your website didn't allow for online donations, but the website encourages offline donations. In other words, there's a page that says, if you'd like to donate to us, send your check to this address. And you actually receive contributions from a particular state on a repeated or ongoing basis, or a substantial basis, then under the principles, you should register in that state. Finally, turning to page 54 and further talking about the Charleston principles. This is where it gets really tricky. So let's say I go on to nonprofit A's website and I decide to donate to them. And in the process of donating to them, I give them my name, my address, my email address, maybe even my phone number, and make the donation. Then the nonprofit A gets my information and they have it. And so they take my email address and they decide to email me 6 months later and ask me for a further donation. Well, now nonprofit A knows where I live. And they're going back to that original question. They have they are soliciting for a donation from me, and I live in state X. So now they've particularly solicited me in state X, which is quite different from my original donation when I just went to their website and donated. So charities really need to be careful what they use, how they use the information they gather through previous donations to resolicit via email or other mechanisms, because that can trip the charitable solicitation requirements. In addition, social media basically has the same rules. So Facebook is essentially another type of website. Facebook pages for charities are generally another type of website for charity. You have a donate option on those websites, on Facebook usually, and other similar functions. So you should think of it in the same way that you would think of your website. If you're soliciting through Twitter or Instagram or other mechanisms, you need to be considering, again, these same principles and how they would apply, and whether you need to register in all the states in which you are receiving ongoing and repeated donations or substantial donations from a particular state. Let's talk a little further about my example about email. Now I'm on slide 55. Soliciting by email can be considered the same as soliciting by telephone or direct mail, giving you that presence in that state. If you knew or had reasonably should have known that you were soliciting me in a particular state. So like I said before, when I went online to the website and now you have my information, when you then email me to solicit, you knew or reasonably should have known where I was physically located and were stepping into that state to solicit me in that state. And in such case, you need to register in that state if registration is required. Well, now we've covered a whole lot of information about what is registration, what is solicitation, generally how you register and the registration requirements. And we've talked about the internet and other things, and it's a whole lot to think about. There's a lot of activities today for charitable solicitation that organizations do on a daily basis. An organization would really be wise to sit down and do a full analysis of how it solicits, in what ways, and all the various different mechanisms for soliciting and who they're soliciting, as well as where they're getting their solicitations, their donations from, and try and analyze that and determine which states it may need to register in. So you can easily find yourself needing to register in multiple states. Well, the state officials, charity officials that got together in Charleston also tried to design a unified registration statement to simplify this, because if you're soliciting in many states, you don't necessarily want to have to file in a separate form in each state. So they tried to create one unified registration statement. Unfortunately, not all the states bought into it. So some states require additional information, some states don't accept that form, and again, it varies. And this is only used for your initial registration, not for your annual or biannual updates that you may have to submit. But there's a great website on slide 56, multistatefiling.org, and it has the unified registration statement, and it also has links to the various states' laws on charitable solicitation. So it's a wonderful resource, and it lays out for you which states require registration and then the laws associated with it. They have summaries, but I always recommend going to the actual statute to understand further what is required under each specific state. But that's a great way to get started when you're making sure that you're registering for charitable solicitation. I now want to spend a couple minutes talking about charitable solicitors. So we talked about the fact early on that it's not just nonprofit organizations that need to register to solicit for donations in the various states, but also fundraisers for charitable organizations, individuals or companies that also solicit on behalf of charitable organizations. So those folks often need to register, and often their fees are higher than nonprofit organizations, and they have stricter requirements. Now, generally, in most states, employees and volunteers of a nonprofit organization need not separately register as a charitable solicitor, even if part of their job is soliciting donations on behalf of the organization. Unless there are a few states where if you're doing in-person fundraising, like you're fundraising at an airport or you're going door to door, in those situations, those employees and volunteers may need to register. But again, it's on a state-by-state basis. Now, the common situation is when a nonprofit hires an independent contractor who is going to solicit on behalf of the organization. And in that case, best practices are, and some states require, that the arrangement be in writing, that in many jurisdictions, that contract must be filed with the state as part of the independent contractor's fundraising registration requirements under the state's Charitable Solicitation Act. But another good rule of thumb is to put into that contract that charitable solicitor certifies that they are active and registered to solicit in all the states in which that independent contractor is going to be soliciting on behalf of the organization. And you can check to see whether your fundraiser that you're going to hire is registered in all of those states. But the contract should state that they certify that they are in fact registered. One other thing to consider if you're going to hire an independent contractor who's going to fundraise for you is that the Form 990 requires the nonprofit, if you hire a third-party fundraiser, to report how much was raised by that fundraiser and then how much the nonprofit actually received of those monies from the fundraiser. They want to do that comparison, and they're carefully watching what third-party fundraisers are doing. So that concludes our discussion of charitable solicitation portion of this presentation. We've now covered the charitable solicitation laws. Each law is different. Every state is different. You need to really carefully analyze your activities and what you're doing in those states to make sure that you're in compliance with all the charitable solicitation laws. Now we're going to turn to a much clearer, more distinct set of rules, and those are the IRS rules on acknowledging and substantiating donations. The IRS requires that nonprofits properly report and acknowledge cash and in-kind contributions. If you don't, there can be IRS penalties, and in some cases, the deduction cannot be taken by the donor. A few things to note: personal services are not deductible. I'll say it again, personal services are not deductible. So if you provide some kind of service to a nonprofit organization, legal services, accounting services, bookkeeping services, any kind of service, even marketing services, it is not deductible. And a nonprofit organization should not provide a receipt to a donor for the value of the time that the person gave. So if I provide $10,000 in free legal services, I should not get a receipt from that charity saying that that's what I've provided. They can acknowledge and thank me for providing free services, but there's no value, and there's certainly not something that is deductible. The donor can also not take the deduction for a donation without some sort of record. So now we're moving away from personal services and general donations. And a donor needs some kind of receipt in order to take a deduction. So it can be a bank record, it can be a credit card statement, but they have to have some evidence of the name of the charity and the date and the amount of the donation in order to take a personal deduction. Turning now to slide 60 and continuing on, a donor cannot claim a deduction of cash donation of $250 or more unless the donor gets a written contemporaneous acknowledgement from the nonprofit organization. So in that case, if it's $250 or more in cash, and that can be over the course of an entire fiscal or calendar year, the donor cannot take a deduction without a written acknowledgement from the nonprofit. And that acknowledgement has to be received by the donor at the time that it files its tax return. Non-cash contributions. The donor, not the nonprofit, should value whatever the item was. The charity should simply acknowledge the receipt of the item and thank the donor for the item and the date in which it was received. But it is up to the donor to value that item. Now, there are special rules if it is a significant dollar value. So if it's a car or a boat or something significant dollar value that's being donated, there are additional rules that apply, and we're not covering those in this presentation. I will say the IRS has a publication, 1771, which is fabulous, and it's all about these rules, and it's actually written in plain English, and people can really understand it. And it also has other resources at the back of it that can help you in this process. So I do recommend going to irs.gov and getting a copy of Publication 1771. It reads like a pamphlet, and it's got all this information in it plus more. Let's talk about recurring donations. So donations that are made throughout the year that might be bundled together. This often happens with churches. You give your check every week when you go to church, and at the end of the year on a quarterly basis you get a statement, and then at the end of the year you get one final statement. And nonprofits can do that. They can bundle up all of your cash donations into one receipt, regardless of the amount. The acknowledgement should include, and actually regardless of the amount, your acknowledgement should include the following information. It should include the name of the nonprofit. It should include the amount of the cash contribution or a description of the non-cash contribution. And then it should include one of the following statements at the bottom of slide 61, and that's going to depend on which one's appropriate. So it should have a statement that says that no goods or services were provided, or a description and good faith estimate of the value of goods or services that the charity provided to the donor in return for the donation, or a statement that goods and services provided consisted entirely of intangible religious benefits. Let's spend a minute talking about the second of those three statements that were on the bottom of the previous slide on slide 61. This is often referred to as a quid pro quo donation. So the nonprofit in this situation, where the donor received goods or services in return for their donation, there's some qualifiers around that. What does that mean and how does that work? The nonprofit must provide a statement to any donor who pays $75 or more and receives something back in return. So the perfect example of that is a ticket to a gala event. The ticket costs $100 and I pay $100 and I get this wonderful meal at this event. Well, on the acknowledgement of the donation, the charity must inform the donor of the amount of the payment that is deductible or that is limited by the amount that was given back in return. So what was the value of my meal? I gave $100, and let's say the value of my meal was $35. Then I can only take a $65 tax deduction, assuming I can take that. The charity is supposed to provide a good faith estimate of the fair market value of the goods or services. What if the charity gets the entire meal donated and they don't pay a dime for it? Well, that doesn't matter because I, as the donor, am still receiving the value of that meal. And I got to go to this event and eat this wonderful meal, and it was valued at $35. So I have gotten that in return, and the value of my potential donation is $65. And that must be included on the donation acknowledgement. A nonprofit is subject to a penalty of $10 per donation if the nonprofit does not provide this information. So this is pretty important. The last thing I want to mention about the IRS rules regarding donations involves insubstantial goods or services. So these insubstantial goods or services don't need to be listed on the donation receipt if certain things exist. Insubstantial goods or services are provided in exchange for the contribution. Don't have to be receipted if the fair market value of the benefits received does not exceed the lesser of 2% of the donation or $102, or the donation is at least $51 and the only item provided bear the organization's name or logo or and the cost of these items is within what is called the low-cost article limit. And for 2013, all of these numbers that I'm talking about apply only to 2013. It was $10.20. Let's explain that a little bit further. So let's say I give $100. If I get back something of value that's $2 or less, then I've met that 2% limit, and nothing has to be put on my donation receipt acknowledging that I got some little thing of value of $2. The $102 amount obviously would be for a much bigger donation because it's the lesser of the 2% or the $102. And so the value of an item up to $102 may not have to be recognized if it falls within the lesser of those two things. The other situation is when the donation is at least $51 and all I'm getting is a pen or a mug or some little item that has the charity's logo on it, and the value of that item, the pen or the mug or so on, is $10.20 or less. That's considered a low-cost article, and that does not have to be acknowledged on my acknowledgement receipt that I get from the charity. These rules and these dollar amounts and that are listed here on this slide 63 change from year to year based on inflation. And every year the IRS puts out a revenue procedure that identifies the amounts for the current year. So those will be listed soon for 2014. And these amounts are for 2013. Now, sometimes you get things in the mail. Charities will send out items in the mail, and they're free, unordered, low-cost items. So you get stickers with your address on them, or you get a calendar. And if it's sent to a person for free, then it need not be acknowledged because you haven't necessarily even given a donation. And you haven't ordered those items. Or if you just get the pen and they hand it to you as part of your donation, you have not asked for that item, so it is, and it's low cost. So those are some of the few little unique aspects of the charitable acknowledgement and substantiation rules of the IRS. We're now going to switch gears, and we're going to actually turn to some fundraising activities. We've been talking about a few of them, but we're going to focus on specific fundraising activities now. We're going to start with cause-related marketing. I mentioned earlier about commercial co-ventures, where you have a for-profit business that does a charitable promotion with a charity for a limited period of time. That's basically cause marketing. So one of the most common examples that we've seen in the last few years was when the Susan G. Komen Foundation and Kentucky Fried Chicken got together, and Kentucky Fried Chicken sold pink buckets of chicken. And for every bucket you bought that was pink, $1 went to the Susan G. Komen Foundation. That is a cause marketing scenario. And basically in that case, you've got company A doing well by doing good for charity B. In other words, people went into Kentucky Fried Chicken and bought pink buckets of chicken because they knew $1 went to Susan G. Komen. It was a great marketing tool for Kentucky Fried Chicken, and it brought in charitable donations to the Susan G. Komen Foundation. Usually in these arrangements, the for-profit company or the commercial co-venture uses the charity's name and logo to sell its products or services, and then they make a donation to the charity based on those sales. It's important for these arrangements to be structured as royalty arrangements, and it's important that the nonprofit not provide additional services to company A. Because if they do so, part of the income from this relationship could be considered unrelated business income. By making it a royalty arrangement and not providing services, it is not considered unrelated business income, but is considered passive income. Turning to slide 65, in addition to sort of the unrelated business income issues and the IRS factors, when it comes to cause marketing, nonprofits also need to be wary of state laws. So the state law, and we talked about this earlier under the Charitable Solicitation Act section, has commercial co-ventures, basically companies entering into a cause marketing relationship. And those commercial co-ventures may be subject to state registration and reporting requirements under the state's Charitable Solicitation Act. Every state is different, and you need to look at each state. But there's usually 3 things to keep in mind in these commercial co-venture arrangements from a state law perspective. First, the test is whether the products are actually sold in that state. So if you're selling the items in that state and you're conducting this co-venture arrangement where the charity is getting a portion of the funds, then you have to comply with the Charitable Solicitation Act of that state, whatever that law is. Some state laws require that contract includes specific provisions. So you want to make it a royalty arrangement, which means you want to have a contract in writing that states that this is a commercial co-venture agreement, and that the company has the right to use the name and logo of the organization, and that the organization is going to get either a percentage or a dollar amount per sale, whatever the agreement is, and that's for a certain period of time. But some states actually have, and that no services are being provided to the company. But some states actually lay out the specific provisions they want to see in this kind of contract. So it's important to check the charitable solicitation laws prior to entering into the agreement. Some states also require that these contracts actually be submitted to the state attorney general prior to conducting the charitable promotion in that state. Some simply require that you retain a copy of that contract for a period of time and retain the accounting in conjunction with the sale, the promotion. I'd now like to very briefly mention, selling or licensing of intellectual property, which is somewhat related to cause marketing. But in this case, we're talking about nonprofits that may rent out their mailing lists. And that's permissible under the Internal Revenue Code, and it won't constitute taxable income so long as there's no services provided. So nonprofits may do that. And they may also rent out their logo, again, through a royalty arrangement that's passive and does not involve services. A common example of this are affinity cards, where a lot of universities have you can get a credit card with the university's logo on it. And in that case, the university has often entered into a royalty arrangement with that credit card company, providing them with their name and logo. Now we're going to spend a couple minutes on qualified sponsorship versus advertising. So advertising income is considered unrelated business income and is subject to tax. Lots of organizations have sponsorship arrangements, and it's very important to meet what are called the qualified corporate sponsorship rules under the Internal Revenue Code and corresponding regulations. This issue came up because the bowl games that take place every year, football bowl games and other related items like the basketball Final Four, where the NCAA and the other organizations that run the bowl games were running into situations where they were being charged. It was being suggested that the sponsorship money they were receiving was actually advertising money and that it was taxable as unrelated business income. So a section of the code was put into place and regulations were added that relate to what is called a qualified corporate sponsorship. So organizations want to meet the qualified corporate sponsorship requirements because if they do, then the income is considered a donation and not unrelated business income. In order to meet those rules, you have to follow the following requirements. One, you can only acknowledge a sponsor, and that acknowledgement should only include the name, logo, address, phone number, and a description of the product or services of that sponsor, and you can have a hyperlink to the main website. Now there's a caveat to that, and that's the next bullet point, which is that the description of the product or services of the company, of the sponsor, should not include any quality or price related information. So let's say, for instance, a furniture company decides to sponsor your nonprofit organization. Well, that furniture company, when you're recognizing or acknowledging them as a sponsor, you should not say that they provide high quality furniture, but simply that they are a provider of furniture, or they sell furniture, or they make furniture. You also shouldn't talk about the latest sale that they have ongoing at the store. So it cannot be qualitative or quantitative in any way, but should simply be an acknowledgement of this company and this is the services they provide, and not say that it's the best services, it's the best product, or any kind of qualitative information. In addition, the nonprofit, in its acknowledgement of the sponsor, should not endorse or encourage the use of or the purchase of donors' products or services. So you shouldn't say, be sure to stop by sponsors' offices or store and check out their latest deals. You should simply acknowledge them and acknowledge their location, name, logo, and what they sell. Finally, another factor is that you cannot give a substantial return benefit to your sponsor or your donor. And this is important in that it goes back to some of the rules we were talking about earlier about return benefit when you're acknowledging or substantiating donations. But any goods or services received by the sponsor from the nonprofit cannot exceed 2% of the sponsorship payment for the year. And that's one of the rules under the qualified corporate sponsorship. If you don't meet these requirements, then the income may be considered advertising income and may be taxable as unrelated business income. So you really want to make sure that when you're working with a sponsor that you follow these guidelines to ensure that you don't have to pay income tax on the donation and that it's not qualified and that it doesn't transfer from being a donation to a payment for advertising services. Now we're going to turn to slide 68. We're going to spend a couple of minutes on these last two slides discussing special events and fundraising through special events. I want to start out by talking about gaming. Gaming includes things like casino nights, poker, raffles, bingo, door prizes, etc. Gaming is often gambling. And so let's talk about the three elements of gambling. They include chance, a chance to win, and the second item is winning a prize. And the third item is consideration, that you've paid for this chance to win a prize. If all three of those exist, then it's considered gambling. And in some states, gaming or gambling is illegal, even for nonprofits. And usually in those states, any kind of gambling activities are criminal, have criminal implications, and are punishable through the criminal code of that state. If it is legal in the particular state that you're located in, which you need to make sure of, it is often heavily regulated. And so nonprofits often must get a local license to conduct any of these activities. So prior to entering into any kind of gaming activities, you need to make sure, one, that it's legal for the nonprofit to conduct that activity within the state. And if it is legal, are there any additional requirements you must comply with, like getting a license from a sheriff's office to conduct such an activity? I want to caution you to also be careful of online activities or activities that might cross into multiple states, because you need to make sure that you're permitted to conduct those activities, these kinds of gaming or gambling activities, in multiple states. And what are the laws within each state? Some states require that the organization be incorporated in that state, or at least be a foreign corporation located in that state before they can conduct gaming activities. Some states just don't allow gaming activities, even if you are a nonprofit. So if you're going to get involved in these kinds of activities, you need to really be careful and understand all the laws that you may be involved in. Another thing that you need to be careful of is that the winnings may be subject to income tax. So if you're raffling off a car and it's valued at $30,000, for instance, and I win it, I have to recognize that winning on my income taxes and on my tax return, and potentially pay taxes on that vehicle. So your winner has to recognize that and acknowledge that, because they might not have the funds to pay that income tax. So there are some significant downsides to raffling off big items like that. The other thing I want to note that's at the bottom of this slide is that there is an exception for traditional bingo under the unrelated business income tax section of the code. So if you're conducting traditional bingo, it will not constitute, on a regular ongoing basis, it will not constitute unrelated business income activity for which you would have to pay income tax. It's a great little coup by some special interest group. Finally, we're going to turn to slide 69, where we're going to wrap up by talking about other special events. And we've talked about a few of these things, but we're going to go over them in more focused detail. Galas, silent auctions, dinners, wine tastings, special performances. Those are the kinds of other special events that I want to discuss. As I mentioned before, a donor's deduction is going to be reduced by the value of anything received in return for the ticket. So the meal that I received in return for my gala ticket reduces the value of my donation. Another important area to understand are silent auctions. When people come to a silent auction and they purchase an item, they're purchasing an item, and they're not making a donation per se, unless they make the donation, unless the amount they're paying for the item is in excess of the fair market value of that item. So if it says that the fair market value of the item is $100 and I make out a check for $150, then that $50 is my donation, and the $100 is simply my purchasing an item. Purchasing a chance to win, like a raffle ticket, is not deductible. So if you're selling raffle tickets, do not suggest that that is deductible, because it is purchasing a chance to win. Celebrity appearances alone do not increase the fair market value of an event. That said, if you have Sting performing at your entertainment at the event, then the value of a concert ticket to hear Sting perform should be included as part of the consideration of goods or services received by the donor. But if it's simply someone showing up at the event, that would not be considered something, a good or service received by the donor. Another aspect to be considering when you're conducting these kinds of activities is whether or not sales tax needs to be collected. When you're conducting a silent auction, depending on your state's laws, the state in which you're physically located at the time, you need to consider whether or not you need to be collecting and remitting sales tax on those items that are being sold. That may also be true for entertainment tickets to entertainment events as well. So you need to be cognizant of that and look at your state's law on sales tax and determine whether or not you should be collecting and remitting that. Finally, galas, silent auctions, and other similar events may be considered charitable solicitation, which takes us back to the very beginning of the presentation where I started, where we were discussing charitable solicitation. So if you're conducting golf tournaments or any of these other events, galas, silent auctions, and it's clear that the purpose is to solicit charitable donations or money for a charitable organization, you need to be cognizant of your charitable solicitation laws, which is where I started this presentation. That concludes our discussion of fundraising activities. Thank you.